Stephen, it seems there's a lot of political risk that we talk about every day on CNBC around the world that, for whatever reason, is not being priced into stocks. Why isn't the market discounting anything political right now?
It's interesting that you think that political risk is not being priced in, Brian, because in Europe, despite the fact that earnings are rising by around 8% this year and we've seen no downgrades, the market is flat to down. So the market's derated, and we think that a lot of that is about political risk. Point A, you've mentioned the negotiations over the Italian budget, which became a pointed issue when the new government was appointed in May. And secondly, trade, which we're still waiting for a resolution to that. But on that, there are some encouraging signs.
I guess maybe I'll ask it a different way, Stephen. I mean, the markets here are at record highs. Many European markets have done well. Do you think we'd be doing even better without this, or are we doing well in spite of everything that you just talked about?
Well, the basic driver for U.S. equities this year is earnings growth, because with the benefits of the fiscal reform, tax cuts are boosting EPS and with earnings per share, and with growth also stimulated by the tax cuts, the leverage effect onto earnings is considerable. So you're seeing earnings growth in the States of around 22% this year, not all of which is driven by tax. And then there's a follow-through into next year. So investors are at the time of the year when they start to think about 2019 earnings and the valuation that brings you in stocks. And I think they like what they see. But it is very much that earnings story that has made the US the preeminent equity story of 2018.
Nobody worried about Greece until it became a big story. Nobody seems to think that Italy is a big story right now. What do you think? Is it?
Well, it's always a big story when a member of the Eurozone puts itself in opposition to some of its partners in the single currency. You know, the way that the single currency operates, it needs to be a rules-based system. And when people want to try and shake the boundaries, if you like, of that rules-based system, then it can lead to friction. But the simple truth for Italy is that with government debt at 132% of GDP, there is very little room for manoeuvre. And I think the move you've already seen in Italian bond yields, taking them to a very large premium to German bonds at the centre of the Eurozone, the issue for them is that every 1% rise in Italian interest rates, long-term interest rates, or their funding costs, adds considerably to their budget deficit, because they have such a large outstanding amount of debt, which continually needs to be rescheduled at those new rates. And therefore, the bond market acts as a kind of a temper, if you like, to restrict the ambitions of those who would like to move the budget deficit out further. So we'll just see where that settles down.
Yeah, I mean, I'm sure you've traveled to the States, right? I mean, it's like, imagine if New Jersey or New York and Virginia or Mississippi.
I was there last week.
Yeah, there you go. They issued debt, and we had this. There's slight differences in debt here among the states, but not as much as Europe. I mean, why is Italy and Greece really? Why are they still such outliers, given that you guys are just one big happy European family, Stephen?
Very happy European family. In the case of Italy, the debt. Aggregation of debt, the build-up in government debt took place not in the run-up to the great financial crisis or in the immediate aftermath as government stimulated their economy, which was the case elsewhere. This is a relic of government policies from the 1970s and 1980s. So if you think back to the middle of the 1990s when governments were trying to qualify for membership of the euro, the size of outstanding government debt was an issue for Italy even then. But the advantage to Italy of being a member of the euro is very, very clear when you think about that. When I started in the city back in 1986, at the back end of the 80s, Italian government debt yielded around 15%. And when you have debt at 90 or 100% of GDP and yielding 15%, that is a very, very considerable interest cost that acts as a headwind to your budget. Membership of the Eurozone has brought Italian yields down very radically indeed, and it means that the interest cost makes that debt more affordable, but as long as they remain on a debt sustainability trajectory. And that's really what this negotiation is all about. There's also a point, Brian, here that the ECB has been supporting the Eurozone economy and buying large quantities of Italian debt. So again, they have benefited from that impact on bringing their overall yields down.